Hello again. Welcome to week 6, chapter 5, and the introductory problem. The introductory problem, remember, is our way of approaching this material to identify the terms and calculations and transactions and journal entries and balance sheet effects that the material has. As I've said in past weeks, you traditionally would be working problems every day, perhaps doing an exercise out of the book and bringing it into class as homework and going over it together as homework, and bringing a problem in or two on Thursday and doing one each hour. And so you would do a number of activities. I'm experimenting with this method of showing you the solution, discussing the solution with you as your introduction to what the problem would look like from the material in the chapter. So I'm assuming that you are reading the chapter, or at least listening to the YouTube on the chapter, and then coming here to see about the calculations. I don't know if that's true, but that's what I'm hoping. So we're using this introductory problem to become familiar with calculations, terms, formulas, transactions, journals, journal entries, schedules that we would make up, all of those sorts of things, topics from accounting. This week's exercise is 5.5a. It's on page 289, and it's about effect of inventory cost flows on ending inventory balances and gross margin. So Dugan Sales has the following transactions for jackets in 2013, its first year of operation. January 20, it purchased 80 jackets at $15 a piece. On April 21st, it purchased 420 more jackets for $16. On July 25th, it purchased 250 jackets at $20. And on September 19th, it purchased 150 jackets for $22. During the year, they sold 830 jackets. So we only know the total of the sales, not the flow of the sales or the timing or the distribution of the sales. But we know that they sold 830 jackets for $40 a piece. So it asks us to compute the amount of ending inventory for Dugan that they would report on their balance sheet, assuming that they did FIFO, assuming that they did LIFO, and assuming that they did weighted average. Now those calculations are on page 271 in the chapter, and you can see them here behind me. So we have exercise, we have the A part, and we have Dugan Sale, and we have a data table here telling us about the transactions. Now when we do Excel, we're going to have a data table that will look just like this, and that will mean that each of these numbers are in a different cell, so we can use those cells for our calculations. So you'll see that in the Excel problem, you'll have a data table like this in the problem, and it'll be presented to you. So here we have 120, 421, 725, 919 purchased, 80, 40, 250, and 50 at 15, 60, 20, and 22. So we're going to multiply, and we'll get 1,200, 6,700, 5,000, 3,300, and we'll get goods available will be a total of 900, which we will compute by adding all of the purchases together, and for a total cost, 90 units for a total cost of $16,220, which we got by summing. So I want you to see this Dugan Sales data table, and I want you to notice how we do this math and set up the year's worth of activities. Now, in the data table you do for Excel, you'll go ahead and expand it to have your sales included, because we're not taking this to the we're not taking this right now to the income statement, but you'll have to do that in your Excel problem. So number 1 says, okay, we have that information, and we have one says FIFO, first in, first out, and it had an ending inventory. Now, the question for us, of course, is how many units are in the ending inventory? Well, if there were goods available of 900 and we sold 830, then there had to be 70 units, 900 minus 830, the difference being 70 units still in the inventory. Now the question becomes, that's the unit count. So the question becomes, under FIFO, we're saying that the first units in, the $15, $16, and $20 units were the first units out. So only the $22 units would be left for our ending inventory. So of this 150 that we bought for $22, 70 of them are still around in the inventory at $22 a piece, and the ending inventory will be $1,540. Now that's first in, first out, but that would mean what was last in was still in the house in the inventory. And the last things cost us $22. Now we're going to look at LIFO, and LIFO is the last in is the first out. So the ending inventory is still 70 units, but now the assumption is that the last units in, the 22 and the 20 and the 16, were all sold, and only the 15, the first inventory, is what's still left in the inventory. So last in was first out, therefore what was first in is still in the inventory. And those were at $15 a piece. So now we have $70 times 70 units times $15, and the cost of goods sold is, the ending inventory is $1,050. Now the weighted average, so let me just review this one more time. The data table says the last things in, 22 and 20, were the first ones sold. So therefore the oldest inventory, the $15 units, were left in the inventory. So the 70 units were all for $15 and came from this $80 level of inventory. Now, weighted average, on the other hand, says the total cost were $1,620, and that was for 900 units. So the average by division, going to divide here, was $18. It probably, this asterisk is telling us it's rounded. I'm going to ask you to probably, I won't be asking you to open it up, but normally I would be asking you to open that up to 4 decimal points, no less than 3. But for right now, we're just rounding these off. So now we say we have 70 units times $18. So that's $1,260 for the weighted average inventory. So now when we say what was the ending inventory, it was $1,540 under one assumption under FIFO, $1,050 under LIFO, and $1,260 under weighted average. So when we're going to record these transactions in the general journal, now the journal entries to record these transactions are back on page 211, back in chapter 14. So the transactions were given to us in 14, and in chapter 4, and now you're learning how to do the calculations for those journal entries. So we're going to be debiting merchandise and crediting cash because we bought them all for cash. And the first one, get up here to our perpetual inventory, $1,200, $67.50, $5,000, and $3,300. So we have each one of those purchases to make. So here's the $1,200 purchase, the $6,720 purchase, the $5,000 purchase, and the $3,300 purchase. Now that's the purchases under FIFO. So we're going to turn our attention then to the cost of goods sold. Now the cost of goods sold are going to be, the sales are cash, debit cash because the sales were for cash and cash is going up, and credit sales revenue because the sales revenue is going up, and that's $33,200 and $33,200. We always on these perpetual inventories have two entries. Cost of goods sold is our next entry. So the cost of goods sold here is the inventories that we did for FIFO. So for FIFO, we had cost of goods sold, and we would have purchases minus our ending inventory of $1,540. So purchases of $1,622 minus the ending inventory of $1,540 to get cost of goods sold of $1,460. Remember, cost of goods sold is going up with a debit because it's an expense, and merchandise inventory is coming down with a credit because it's an asset. So those two accounts are both changed by $1,460. Now notice that the sales on both FIFO and LIFO and weighted average are all the same because we have the same number of units and they all sold at $40. So we're going to have this sales entry being the same. Debit cash, cash is going up, and we have more cash and it's an asset and we increase it with a debit. Sales revenue is an income account, it's a revenue account. We have more revenue because we sold these jackets, so we're going to credit that revenue to increase it. So that entry is going to always be the same. But now, instead of $1,460, we get goods available at $1,622 right there. And now for our ending inventory under LIFO, we have $1,050. So when you take $1,660 minus $1,050, you get this $1,500 expense, $15,170 expense under LIFO, much higher expenses. So we're going to be debiting cost of goods sold and crediting merchandise inventory. Debit the expense, cost of goods sold, to make it go up by $15,170, and then merchandise inventory, the asset going down, so you credit an asset to reduce it by the same amount, $15,170. Again, looking then at, we got that number again, let me just refresh this for you. We had goods available of $1,620, we had ending inventory of $1,050, and the subtraction, the difference between those, are how we got the $15,170. Now when we look at weighted average, we have the very same sales transaction. Debit cash, credit sales. Cash is an asset going up, sales is an income account going up. But then the expense account that we recognize is the 680 jackets times 630 jackets, times the average price of $18, and then that gives us that cost of goods sold. Or we can also get it by the same way we did the other ones, of looking at goods available minus the ending inventory to get the cost of goods sold. So we can get that answer or either way, and as I said in my presentation, you can also use the units And you'll have to do that in your Excel problem. You'll have to use the units times their selling costs to their individual purchase prices to prove that your ending inventory was correct. Now then, the next part of this asks you to do the T accounts, and the T accounts are on page 213. These are the same T accounts that we've been seeing. Here is FIFO, so we're looking at FIFO right there. I was afraid I was going to lose that. There's FIFO. We've got cash and merchandise inventory, sales revenue, and cost of goods sold. And you post these to the T accounts just like you have transactions all the way through, and we get those account balances. So you're going to want to be sure that you can post them with these account calculations. Remember, the only thing that's different here is you calculated the amount of those journal entries from Chapter 4, and then you're posting them just the same way you did when you did the comprehensive problem in Chapter 4. Here's LIFO. Aha, I couldn't get that. Here's cash and merchandise inventory, sales revenue, and cost of goods sold. And you're going to post those transactions to these T accounts just the same way you did in Chapter 4, and as is demonstrated on page 213. Now, as we continue this, here's weighted average. Again, it looks exactly the same, so you'll post those. You're just going to be getting some different balances in these accounts. So in cash, it's $16,900, $16,900, and $16,900. There's no difference in cash in any of these methods. The only thing that's going to be different is our expenses. So when we get revenues will be exactly the same, but cost of goods sold, revenues are the same, but cost of goods sold are $14,680, $15,170, and $14,960. So that expense subtracted from those revenues to get profits will be different in every instance, and so you'll get a different profit and a different tax obligation. So we've now looked at these and put them into an income statement, and we're going to get the net income. Actually, we're going to get the gross margin. So here's the sales under FIFO. Here's the sales. Here's the goods available minus the ending inventory to get the cost of goods sold. Just exactly the number we got in those transactions, in those calculations above. And now the gross margin is $18,000 under 1, $18,500, $18,030, comparing LIFO and FIFO. So again, when we look at this difference in the gross margin, there's $490 difference in gross margin, and you're going to save yourself paying 30% of $490 in taxes. Now, if that was $490,000, or even $4,900,000, it would be well worth saving 30% of that in taxes to do these calculations and to keep the records for this set of books. So this is what I wanted you to see from the introductory problem. I wanted you to learn by way of review quickly here that you have a data table, and we put our information about our company in the data table, and then we're going to use the cells in Excel. We're going to use this information in the cells to do our calculations, to do our cell formula calculations. We're going to calculate ending inventory using FIFO, using LIFO, and using weighted average. And then we're going to write our journal entries for our sales, for our purchases, which would be the same in every case, for our sales, which will be the same in every case, and then we'll have only the cost of merchandise inventory will be changing for each of the cost flow assumptions because our cost of goods sold changes. And then we'll post those through and prepare income statements, and when we look at these income statements of sales to get gross margin, our gross margin is different by $490. That's a brief introduction to the material in this chapter about inventories. These are for perpetual inventories, and so as we look at them, we can begin to see how our profits change and our tax obligations change. Again, I welcome you sending me an email, asking in class, coming by and seeing me during office hours. If you have any questions on this problem, I invite you going over this problem so you can begin to say, oh, that's where that $40 came from, that's where that $15 came from. I can see how that's done. And then we'll be ready to work our own problems. Thank you for joining me. I look forward to reading your discussion boards and Excel problems and comprehensive problems on this chapter.